Hello everyone and welcome to chapter number 12. So in this chapter we are going to look at riskier mutual funds. So we are going to talk about equity mutual funds. We are going to talk about like some special types of mutual fund like international funds, right? So the products that we are going to discuss in this chapter are riskier mutual funds. Now one caveat before we begin. So these products are high on risk. So when you're recommending them to the clients, right, you have to be very careful about whether the client has the capacity and the traits to take on these riskier mutual funds. So if a client is rich, the client has a lot of time horizon, then you can recommend these mutual funds to them. But if you recommend them to a conservative client, they might lose money and that might get you in trouble. Okay. Also, in exam, right, whenever these products come up, right, they have very high risk. So in terms of risk metrics, they're very high risk products compared to, let's say, balanced mutual funds, or compared to, right, even the conservative mutual funds that we discussed in the last chapter. So you need to know that they are high risk products. So first we are going to look at equity funds. So we are going to look at the risk return graph, but right now the risk is very high. The expected returns on equity funds are also high. So equity funds contains stocks or equities. So shares of companies are included in them. So what is the objective of an equity fund? The objective of an equity fund is growth. So they are looking to grow your money, which qualifies for capital gain taxation. So they're looking to generate capital gains. So mostly you have to be concerned about capital gain taxation. There is some opportunity for dividend income also, because stocks usually also pay dividend. An equity fund, so let me start the pointer. Okay. So an equity fund is primarily concerned with market risk. This is very important for the exam. So like conservative mutual funds like debt mutual funds and let's say money market mutual funds, they don't really have market risk. Market risk for the exam purpose is very unique, right, to equity funds. In an actively, again this word you will hear a lot in equity mutual funds. What is actively managed mutual funds? So there are two kinds of mutual funds, active and passive. In an actively managed mutual funds, the fund manager does stock picking. So he selects stocks based on fundamental and technical factors about that stock, right? In a passively managed mutual fund, the fund manager does not do stock picking. He merely selects stocks from the basket of he merely selects stocks to match a basket of security like an index. So they're mostly picking up stock based on stocks already present in an index. So in an actively managed mutual fund, they also have some unique risk. So this is important to distinguish. Passively managed mutual funds do not have unique risk because they're most of the time well diversified. But in an actively managed mutual fund, right, the fund manager does stock selections, so they might not be diversified, so they might have unique risk, as a manager may select poorly performing stocks. Managed funds are ideal for active investors who feel that the markets are inefficient. Again, testable things. If you think markets are efficient, you most likely go with passive funds. If you think markets are inefficient, you most likely go with active or managed funds. Important for the exam. There are three main types of mutual funds. So you have standard equity funds, okay, so actively managed standard funds. Then you have equity growth funds who focus more on generating capital gains, right? So they try to go for high risk investments. And equity index funds, so these are passive funds that basically follow a specific index. So I'm going to show you examples of all three. Okay, so let's go to Google. Okay, so I'm going to look at, we're going to compare all three. So BMO, Canadian equity mutual fund. So I don't want an ETF, I want an mutual fund. So let it populate. Okay, so this is a BMO, Canadian Equity Fund. So what does Canadian Equity Fund means? It makes investments in Canadian stocks. The fund's objective is to increase the value of investments, that is to generate some growth again over the long term. So these funds are not short-term investments, they are long-term investments. The portfolio manager uses a bottom-up fundamental investment process to identify attractively priced equities. Okay, so this bottom-up fundamental means they are doing stock selection, so it's an actively managed fund. It's not a passive fund. It is not following an index. The fund manager is doing fundamental analysis to select stock, right? The process includes analysis of companies' financial statements, managements, and valuations. Who should buy these funds? If you're looking for a core equity fund for your portfolio, if you're comfortable with risk. So these funds are risky, so you need to be comfortable with risk. Since inception, right, this fund has given 7.31% return. 30 years returns are on an average 7.7. These are annual returns, average annual returns. So every year it has given 7.75% in the last 30-year period. Since inception, this is 7.31%. 20 years return is 6.11, 10 years, 5 years, so on and so forth. Year till date means in 2024, right? Since the start of the year, this has given 6.02% return. The minimum investment is $500 one time, and you can start a monthly minimum contribution of $50 per month. The management fee is 2.39%. The fees that you pay every year is 2.39%. You can add them into all of these accounts: RRSPs, tax-free savings account, RESPs, etc. What do they contain? Mostly Canadian stocks. So Royal Bank of Canada, then Canada Pacific Railway, Suncor, Shopify, etc. Okay, the unit price, if you see the price, the net asset is almost $1 billion, right, in millions. So it is $1 billion, $1.6 billion, and the price per unit is 42.0292. So this is an example of a flat out Canadian equity fund. Then if you go to, let's say, growth funds, so let's filter it for growth funds. Okay, so growth funds have higher risk than normal equity funds because they target, right, high risk companies. The objective is to provide long-term capital growth, right? So it invests in companies around the world. So it is also an international fund. So bottom-up fundamental analysis is used, right? So emphasis on securities that are attractively priced with potential of above average earnings growth. So they're looking for companies that are growing very fast, right? So fund may invest up to 50% in foreign securities, etc., etc. Minimum investment is $500, right? Additional investment is $50. Year till date, it has given 13.24% return, right? The price is $20.29. The net assets are $261 million. The management expense ratio is 2.24%. Since inception, it has given 8.85% return, right? So higher than the normal equity fund that we were looking at. So 5 years return per year 9.61, right? So on and so forth. Companies different, so it consists more of like software companies, Dollarama, right? The companies that are growing fast, Okay, so $10,000 invested in 2015 have become 11,231 right now. The expense ratio is 2.24. The fees that you pay every year is 2.24. Okay, then let's look at the third type, index fund. Okay, so we might have to search for it. So reset filters, filter mutual funds. We want index funds. Sometimes better to search on Google rather than the website. So Canadian equity, let's see if we can get an index fund. No. BMO index funds. Yeah, this could be an example. So it's a US based fund, right? So what is the fund objective? It is to invest in companies that consist of a US index, S&P 500. So it will buy only companies that are present in the index S&P 500, which is an American index, right? So invest in exchange traded fund, right, etc., etc. So it uses some derivative options, etc., to manage risk. The details are as follows. The MER is 0.98%, so way lower than the funds that we were looking at. 2.6 and 2.24%, that were the MER. Okay, so index fund, the MER is way lower. Minimum investment is $500. The additional investment $50 per month, right? 20 years return 8.68%, since inception return 7.19%. How do they allocate? They allocate based on S&P 500. So whatever companies are part of S&P 500, right, they invest in those companies. Okay, so 10,000 invested in the year 2000s, right, has become $59,000 right now. This is the management team that makes investment decisions. So this is an example of a passive fund. Now, what's the major difference between the three funds that we talked about? So let me go to a Google sheet and explain those differences. Important to understand as an investor. Okay, so let me see if I have a sheet already. This is chapter number 12. No, I don't have chapter number 12 sheet. So let's start a new sheet. So see IFIC chapter 12. So we discussed three types of fund. So we discussed a equity fund. The important part for the exam you have to remember, so this is actively managed, okay, and it can have unique risk. Okay, then we saw a fund that was giving around 7% return. So returns on this fund were on an average 7%, let's say, and an MER of 2.6%. Then you saw an equity fund which was growth oriented. So again, what is growth oriented means? They have higher risk than normal equity funds. They have higher returns too usually, and they are actively managed, and they have unique risk. okay, plus the returns were higher, around 8%, and the MER was little lower in that case, but it might not be necessarily true, right? MER is a fee, the yearly fee that you are paying on entire money you have with the fund. So MER was little bit lower. So this was growth oriented fund. Then we saw the third one, which was, right, index fund. So what do? They follow an particular index. So they invest in companies that are present in an index. So what index are available in Canada? So we have different indices. So we have Canadian indices. So S&P, like TSX 60. So it composes of top 60 companies in Canada. We have S&P TSX Composite. Which is around 200 plus companies in Canada, top 200 plus companies in Canada. Then you have S&P 500. This is an American index, or like NASDAQ 100. Or Dow Jones is also there, but mostly people do not invest in Dow Jones. So these are the indexes that index funds can invest in. Okay, what's the feature? They have market risk, but no unique risk. This you have to remember. They have no unique risk because they are usually diversified. But growth funds have market risk and unique risk. Equity funds also have market risk and unique risk. Second, they are passive. Okay, and the returns and MERs are as follows that we saw. Returns were around 7% and the MER was 0.98%. So lower MER than equity and like growth and index equity actively managed and growth funds, lower MER than them. So just for curiosity purpose, so if you make a $10,000 investment in these funds, right, how would that work for the next 30 years? So I'm just going, this calculation not important, but I'm going to show you why index funds are usually considered to be better investments. Okay, usually. So let's say you invest in time period 0, $10,000. So you pay fees on that. Fees are 2.6%, let's say. Okay, and this is, we are talking about a normal equity fund, not a growth fund, normal equity fund. So next year you will get 7% return on an average. So investment amount minus fees into 1.07, then fees will be calculated on that, so on and so forth, right? So you will, at the end of 30 years, you will have $34,000 and you will be paying fees for all those 30 years. So total fees are $16,000. So you paid $16,000 of total fees and your fund value was $34,000 if it provides an average return of 7%, right? Now, what happens if you invest in an equity growth fund? So let's do that. So same calculation, except the returns are different now. The returns in equity growth funds were little higher. MER that we saw was also little lower. It was 2.24%. So drag this down. So total fee is little lower. The fund value is little higher because returns are also higher and the fees is also little lower in that fund. What happens if you invest in an passive fund, that is an index fund? There are better options than this index fund. The fees is still higher, right? But let's go with that. So fees are 0.98% now. returns are similar, around 7%. So fees, see, the value will be significantly higher. You will end up with $56,000 versus $38,000 in a growth fund versus, right, $36,000 something on a normal equity fund. So not here, let's not change here, let's change here. This was passive fund, so 0.98, so that we can compare. Again, calculations not important. I'm just showing you, if you pay lower fees, what happens. Fees are very important consideration when you are making investments. So $57,000 is the result, right? Fees, total fees that you pay will be $24,000 at 0.98%. So significantly higher amount you end up with, right, because of lower fees in an index fund. So index fund gives you $57,000 in 30 years. This gives you $30,000 because fees itself are $16,000, and this gives you $38,000. So if you believe that markets are efficient, it is better to go with an index fund. So with that discussion, let's cover the PowerPoints now. So what is a standard equity fund? We discussed that. Note that there are no equity funds that are called as standard. The term is used to differentiate this type of equity fund from other two of equity funds. What is the objective? The objective is to earn combination of dividend income and capital gains by buying and selling companies' shares. While earning some measure of dividend income is part of the objective, the primary focus is capital gain in a traditional equity fund. There is no specific attempt to preserve capital, so safety is not part of the discussion, as equity funds are quite willing to put their capital at substantial risk in hope of generating higher returns. This is suitable for clients with long-term investment horizon. So example, Mike, who might have a long-term investment horizon and a rich client, these funds would be suitable for them. Then there are equity growth funds. What is the objective? Again, the focus is capital gains. They might generate some dividend income, but that's not the priority. What do fund managers do? Fund managers in a growth fund usually invest in smaller companies that do not have the ability to pay dividends or do not plan to pay dividends because they keep profits for growing the business. So no dividend paying companies is the focus of growth funds. The companies need all their capital in order to grow. If those small growing businesses are successful, the share prices of the firms will rise to reflect the growing value of the business. So growth is the focus. Risk, the potential failure of smaller firm is much higher, right, than for large matured businesses. So the growth fund also have unique and market risk which are higher than normal funds. And aggressive mutual funds invest exclusively in smaller, less known firms. Typically a differentiating question. So this differentiates them from a normal equity fund because they specifically target smaller, lesser known firms. Sometimes these funds are also called as small cap funds, and because of their nature makes them specialty funds. Small cap companies, just for your information, are usually companies who are smaller than $1 billion, often in the range of $100 to $300 million. So their capitalization, that is the size of the companies that these funds target, is usually smaller companies. Market cap, it is size of the company between 100 to 300 million. Numbers are not important and not part of the exam. Then there are equity index funds. So they hold common shares, but it is considered a passive investment for investors who feel that the markets are efficient. So market risk is the primary concern. Unique risk is not there because most of them are diversified. The strategy is to track an index like S&P TSX Composite, which consists of 200 plus companies. So the fund holds shares with similar weighting to the index, and it tries to replicate the index. What is the objective? Objective is to grow via capital gains, the same as actively managed funds, with some dividend income. There is an alternative though to index funds, which is to buy an ETF on underlying index. We will discuss that in chapter 13, that is the next chapter. ETFs, just for your information, will have even lower fees than, let's say, an index fund. To just show you the comparison, we saw this equity fund, which is an S&P 500 fund. The MER was 0.98%. If you see an ETF, example VOO is an S&P 500 ETF. Same concept, except they're traded on stock exchange. So if you go to their information docket, the expense ratio is 0.03%. So it is even lower than the index fund. Index fund first was 0.98%. So same returns as the index fund, but the expense is even lower. So if you had invested this amount in an indexed ETF, $10,000, the fee structure is very low, 0.03%. So $3 is the fee for first year on a $10,000 investment. So if you do this, you will end up with $76,000. So $26,000 difference between an index mutual fund and an indexed ETFs. So index ETFs usually have even lower MERs than the index mutual funds. Okay. Then risk and return. Risk in an equity fund, only market risk for passive funds, market risk and unique risk for actively managed funds. So growth and normal equity funds have market and unique risk. Passive funds only have market risk. Returns, some dividend income, but mostly capital gains. Okay. So this graph shows how equity funds perform, right? So if you see money market fund is this return, lower. If you see S&P TSX index, this is how the index has performed. Then this is where equity funds have given returns. So returns are little lower than index because of the fees. Okay. And growth funds returns are here. So you can clearly see that if you invest just in the index, you will usually be better off than in investing in a growth fund or a normal equity fund. Okay. Now there are special types of fund. So some people want to be responsible with their investment. Responsible means they want to follow certain norms. So environmental, social or governance norms. So ESG, right? So there are special funds that invest in companies that qualify under the ESG norm. So it refers to incorporation of 3 topics that have become important factors in selection of management of investment, right, of all types by individual investors, by mutual fund managers. So mutual fund managers, along with good companies, they also look for the ESG score, how the companies are performing on environmental norms, social norms and governance norms, collectively referred to ESG, which is some of the most important drivers of sustainable investing that causes investment managers to conduct extra due diligence of potential investments to include in their portfolio based on how closely the issuers of this investments deals with ESG. So the focus along with returns is also on the ESG score, how the companies are performing on ESG. There is growing evidence that incorporating ESG factors into investment decisions can reduce risk while also improving long-term financial returns of the companies. Okay, this is very debatable. This is what is given in the book, right? Follow this for the exam. Personally, ESG companies in the last couple of years have underperformed the market, right? So this is very debatable, for at least for me. So if you see, let's look at some ESG fund. So generally socially responsible fund. So we might want it from BMO. Sustainable portfolio, ESG investing. Okay, we want a mutual fund, so let's look at a mutual fund. Sustainable opportunities, global equity fund. Okay, so let it populate. The management fee is 1.18%, right? It looks at the environmental, social and governance norms, right? Usually it has performed better than the market, but last like few years, if you see, right, returns have been lower than S&P 500. 5 years return of S&P 500 are higher, right? Since inception, 10.4% returns. Invest in like mostly socially responsible companies who qualify under the ESG norm, right? So this is the fund. $10,000 invested in 2016 has become $22,000. Personally, I just put my money in an index ETF, lower MERs, right? Better returns. Example, if we were looking at Vanguard, which is an index ETF, if you see performance, okay, 5 years performance, 15 years 15% returns on an average, since inception 14.51%, way higher than even an ESG fund with very low cost. This has a cost structure of 0.03, right? This sustainable equity fund has cost structure of 1.18%, so very high. Okay, it's just my take on it. RIs, responsible investing funds, began to get developed in the 1970s. During that time, it was called as ethical investing. Since then, shareholder activism, corporate engagement has become very common in not just investment markets, but business and social environment as a whole. So they mostly include topics. So they mostly focus on topics of climate change. So companies that are working on the new energy environment, water scarcity and management, sustainable supply chains, indigenous and community relations, executive compensation, right? And companies that focus on diversity and inclusion. Then in equity funds, you will also find balance funds. So what is balance funds? Balance funds invest in like stocks and bonds both. So they are a combination of fund that invest in equity and bonds. So they have exposure to stock markets and fixed income markets. So balance funds invest both in fixed income and equities, which makes them part fixed income funds and part equity funds. So they generate capital gains and dividends from equity investments, and they also generate coupons, that is interest income, from fixed income. So they invest in corporate bonds, government bonds, and common shares. The balance represents opportunities and objectives of safety, income, and capital gains, not necessarily in equal amount. So it could be very different for different funds. So it is not 50-50. It's not 50% equity, 50% fixed income. It can be very different. Since the portion in fixed income and portion in equity may shift depending on market condition, this fund is also known as asset allocation fund. Important for exam. Balance funds are also known as asset allocation funds. Let's look at an example and then go back to the slides. So let's say BMO balanced funds. This is a portfolio. I want a fund. This is a mutual fund. Okay, so let it populate. So this is an BMO asset balance portfolio, right? So it uses dynamic asset allocation, reviews and rebalance the portfolio on an ongoing basis. So the returns, year till date returns are 6.33% since inception returns. Of course, balance funds have lower returns than equity, right? Because they also invest in bonds. So 4.10%. The management expense ratio is 1.58%. Where do they invest? So they invest in like S&P 500, then bond index, so on and so forth. So bonds and equity both. Okay, so $10,000 invested in 2017, let's say, have become $13,000 till date. So this is an example of a balance fund. So generally, bonds increase in value as stock decrease in value. So bonds and stocks have inverse correlation. When the stock market is doing well, bonds usually are stable. They don't rise too much in value. But when stock starts to fall, right, the bonds are considered to be safe havens. So they might increase. And reverse can also be true depending on what happens with Bank of Canada and FOMC. So Bank of Canada decides the interest rates in Canada. Fed decides the interest rates in United States. Both these players are very important in the bond market. So balance funds get impacted because of these decisions. Okay. Objective of a balance fund to seek combination of current income from bonds, capital gains from, let's say, stocks, and some preserving capital using money markets. So safety, income and capital gains are objectives. Risk: a balance fund has a default risk which is additional to, right, market risk, right, because they have bonds in them. So they have all three risks. So they have default risk, they have interest rate risk because of bonds can default, bonds can change values based on interest rates, and market risk because they also have stocks in them. They also might have some unique risk if the manager, right, is timing the market incorrectly. Return wise, if you see, like, this is the bond fund, this is the return of a balance fund, and this is the return of a Canadian equity fund. So equity fund returns are higher, followed by balance, followed by bond funds. Okay, then a type of balance fund is a target dated fund. So these are special funds, right? Why they're special? Because they're also known as life cycle funds which have a glide path. So I'll explain what a glide path is. So these funds have dates on them, right? When the fund is young, it will have more stock allocation. As the fund ages, right, it will have more bond allocation. So these funds initially have higher stock allocation. As the fund starts to age, they go towards more bonds and money market. Okay, so let's look at an example, then read through the PowerPoints. So target date fund, mutual fund. So let's look at Canada. So Fidelity has an example. So life cycle portfolios, that is what they are called. Okay, so dates are mentioned. So let's look at, let's say, 30 years from now. This is 2020. So 2024 plus 30 years is 2055 almost, right? So this is a fund that will mature on 2055. Okay, so if you see, the MER is 2.29%. okay, the returns you can get, the returns have been like, this fund started in 2017, so 11.7, year till date 11.6. since inception, return is 7.38%. right, medium risk, the allocation right now is more towards equity, very low towards bond. But as the fund matures, right, the allocation will move towards bonds. This fund has 30 years to go. As the fund, right, progresses in age, as we move towards 2055, the fund will move towards more bond allocation. If you see some bonds maturing right now, some funds maturing right now, they will have higher bond allocation. If you see 2030 portfolio, let's say 6 years from now, a fund maturing 6 years from now, right, equity is still there, but they're moving towards investment grade bonds, right, global bonds, and so the fund had zero allocation. This has more allocation towards bonds now. So as fund progresses in age, right, they will have more allocation towards bond. The MER is 2.15%. okay, so glide path is an important word because it's very unique to target dated funds. Anytime you hear glide path in your exam, that is, they're talking about target date funds. So example of a question, which of the following will have a glide path? So answer is target dated funds. They're different from other funds in that they both have a maturity date and a glide path. Investors will select a fund with maturity date that matches their life goal, such as retirement. So whatever date you are going to retire on, right, you will, or whatever year you are going to retire on, you will choose a fund matching that. The glide path refers to changes in fund's asset allocation over time, which allows the fund to pursue a growth strategy by holding risky investments in early years and then gradually reduce the risk of the fund as the maturity date approaches. So initially they could be 80% equity, 20% bond. When they come closer to retirement, it could be 80% bonds and 20% equity. Okay, they are very popular, right, driven by demographics. Baby boomers who will retire in significant numbers over the next 15 to 20 years love these funds. Then there are global funds or international funds. So global funds, as the name suggests, right, they make investments outside of Canada. What is the objective? They can have same range of types of goals of a domestic fund, but going global or international adds another layer of diversification. Any of the mutual fund discussed can be purchased as a global fund. So they have again growth global funds, normal global funds, or indexed global funds too, passive global funds too. These funds will have all the risk associated with the investments they hold. Plus, this is very important for the exam, they do have currency risk. They do have currency risk in them, right? So these funds have currency risk in them because you're not making investments in Canadian dollars. Global funds invest in global companies. So they have foreign exchange risk. That foreign exchange risk can be hedged, right, using a forward or a future contracts. Some funds do that, some funds do not. So I'll show you an example. Okay, so we can look at unhedged emerging market fund, and we want Canada. Emerging markets are developing countries like let's say Brazil, Argentina, like India, all of those. So this is an Fidelity Emerging Market Fund. It is unhedged, means you're taking on currency risk, right? So holdings, if you see like Taiwan companies, Samsung Korean companies, Chinese companies, right? So Mexican Walmart, etc. So different companies than Canadian companies. So when you invest in them, right, you're also taking on right? Currency risk. Okay, if you see hedge means currency risk has been eliminated. Usually you have ETFs, so BMO, like emerging market, this is a bond ETF, but it is hedged. Hedge means you're not exposed to currency risk. Only returns given, right, by the companies, by the bonds will be a factor. Currency risk has been hedged, eliminated. Hedge means eliminated. So this is an example of a bond global fund which is hedged. You can have equity as well as bond. So other risks that are present in international funds, important for the exam, they might have liquidity risk because markets might not be matured enough. For example, if you invest in a fund that targets some developing country, right, though the developing country might not have a developed equity market, so it might not have liquidity. Okay, foreign funds may not trade as frequently, so they might not have liquidity in them. They have efficiency risk. Foreign markets may be less efficient than Canadian or American markets. They have foreign market risk too. The foreign markets may have less supervision and control of accounting. Very important for exam. So global funds have currency risk in them if they are unhedged, right? Along with that, they have liquidity, efficiency, and foreign market risk. So overall, they're way more riskier than a domestic equity fund. So global funds, if you see, right, sometimes the Canadian funds outperform, sometimes the global funds outperform. Right now, Canadian and American funds have been outperforming other countries' funds. Then you have specialty fund. They usually lack diversification, so they invest either in a particular sector or a particular country, which means they tend to concentrate their holdings. Example could be a Latin American pharmaceutical growth fund. So it only invests in Latin American companies, so Argentina, Brazil, Mexico, and they only invest in pharma companies, that too smaller pharma companies, because it is a growth fund. Fund may specialized into focusing on gold, precious metal, high yield bonds, energy, etc. Example, there is an ETF called as GLD that invests only in gold. So if you see GLD, so it's kind of a mutual fund that only buys gold, right? So this is a very specialized fund because it is focused on buying only gold. So if you see performance, average annual returns, last 3 or 4 years gold has done well, but 10 years returns, if you see, it has been 5.47%. They very often the goals and objectives of a specialized fund are aggressive growth. These funds would be considered very high risk and may not be suitable for all investors. Remember, investments should not be considered in isolation but as a part of entire portfolio. Risk and return of specialty funds. Risk, they're not well diversified, so they are market and unique risk. Returns, they usually focus on capital gains. Then you also have fund wraps. So what are fund wraps? These are mutual funds that invest in other mutual funds. So this is a mutual fund consisting of multiple mutual funds to fit a pre-selected asset allocation. So it's a mutual fund that might invest some money in equity funds, equity mutual funds, some like bond mutual funds, some money market mutual funds. So it's a mutual fund investing in other mutual funds. It outsources the management and security selection to different managers with responsibility of overall asset allocation falling to the wrapper sponsor, that is the lead mutual fund. So wrap is a mutual fund that invests in other mutual funds. All administrative, management and trading costs tend to be rolled into one wrap fee, right? So one fee that you pay consists, like, all the fees are added and you just pay one wrap fee. investor own units in pool of other mutual funds. So effectively they own units and shares of a fund of fund. This is also called as fund of fund, important for exam. Because of this, fees can be very high, very testable in the exam. This is a very high fee product. So which of the following has very high fees? Fund wraps or fund of fund is the answer for most cases. They have higher fees than normal equity fund. They have higher fees than like index funds, right, etc. For the client, the process of buying and selling unit in a fund wrap is the same as buying any other mutual fund. Okay, not testable in the exam, but we discussed like what are small cap companies, usually companies less than $1 billion. Example, like Vijax is a small cap company in Canada. Then medium cap companies, usually market cap $2 to $10 billion. Cineplex is an example. Large cap company, usually more than $10 billion. TD Bank is an example. What is a market cap? Total number of shares issued by the company multiplied by the current market price. So it indicates size of the company. This is very testable, very important for the exam. So we discussed, right, different funds. Money market funds, lowest risk, lower returns. Mortgage funds, right, invest in mortgages. So again, low risk product, right, and lower returns. Bond, like higher risk than mortgage, right, but lower risk than everything else, and returns are corresponding. Balance fund, combination of bonds and stock, so somewhere in between, right? From here, riskier funds start. So dividend funds focus on mature dividend paying companies. Risk is higher than balance, lower than equity. Returns are somewhere in between. Equity funds, here real estate funds, they invest in real estate, like they buy properties, so residential or commercial, so higher risk than equity. And there then you have specialty funds, the highest risk product. So that completes the chapter. Thank you for watching the video. I hope you enjoyed it and that helped you to prepare for the final exam. Now, if you're interested, the entire course is available for level 2 members. So if you become a level 2 member on YouTube, you get access to the entire video course, right? It has some additional numerical examples that I have gone through, right? So it helps you prepare for the exam. Plus, it also has a question bank. So you can also subscribe to the question bank, right, once you are a level 2 member on YouTube. So how do you do that? So when you go to the home page, you can click on join, right, and there are 3 levels that you can join at. So the IFIC course, right, as well as the question bank is available to people who are level 2, that is this level and any level above that. So this level gives you access to IFIC and CSC video course and question bank. This gives you access to all the courses. There is financial planning, there is corporate finance, all kinds of courses that I have. So you can join at whatever level you want. So you click on join, you pay the fees. Once you do that, if you go to the community tab, you will get the free code for it. So it will have a free code for the question bank and free code for the video course. Okay, so thank you for listening. I hope you enjoyed it. Have a great time.